All right, what's up, analysts? So I want to take this opportunity to make a really great educational video on what it means to actually hold a stock and then keep track of it once you have it. Um, I don't believe in buying and just holding forever because the whole point is that I'm trying to find businesses that have intrinsic values up here and prices down here. And if this price gets a little bit too up, or if the intrinsic value starts to go down a little bit too far, I want to know about it. So it's a good thing to check out all of the quarterly statements that the company issues. Some people don't follow that rule. Some security analysts don't. They just look at annual statements. But, I have a little bit more time on my hands. I say, why not? Take a look at this. So ULTA Beauty, this is a stock that I do have holdings in, and once again, I'm not making financial advice for anyone to purchase this stock, but I want to calculate a few of the measures that I've used in the past to evaluate stocks. So the first one is earnings. Earnings is a pretty basic one. So if you start with net income, and now we have a new number for August at 566 million. We're going to first find the discrepancy between last year's 26 weeks ended and this year's 26 weeks ended. And you'll see what that entails shortly. So 647 minus 566 gives us an 81 million discrepancy. So I'm just going to put that right here. Then with that number, we can now kind of figure out the estimated annual income for the year 2025 ended. And we can do that because now that we have this discrepancy between 2024's numbers and 2023's in this case, we can now extrapolate based off that $81 million discrepancy what next year is going to be. And we can do that in this case by subtracting 81 million from last year's annual statement to get this year's annual net income. So we go there, we go to February 3rd, 2024, year ended, and we find net income. It's at 1291. So our answer in millions for 2025 net income is going to be this, 1210. And so now we can use that to figure out an earnings per share. The way we can do that is divide by the number of shares outstanding. You can find that in the income statement. So it's saying 48. Oh wait, this is the annual statement. We're going to look at their most recent number. So as of August 3rd, it is saying they have 47,300 shares outstanding. Okay, that's in millions, so it's 47.3 million. So divided by 47.3 million, and we have a PE ratio of 26. So, oh wait, sorry. My mistake. That is not the PE ratio. My heart dropped as well when I looked at that. This is the earnings per share. Earnings per share of 25.6. I would never buy the stock if that was the PE ratio. Now we're going to look at their price to find the PE ratio. So 351.6 is our number. We divide by the earnings per share. It is kind of futile to put in these decimal points because the whole point to value investing is that you're not finding the exact intrinsic value because you can't. It's impossible. There's so many qualitative and quantitative factors, but you can have a range. And so that makes it a little bit stupid to put in the decimals. I could even round this down to like 300 or 400 and it would be the same idea. But just going to be exact for the sake of the video, this is going to be the PE ratio, 13.7. Still undervalued. Phew. 13.7, just to give you an idea of what that means as a PE ratio, it is slightly higher than a neutral outlook for the business, which is at 12. Neutral means nothing good nor bad is going to happen. They're kind of just going to stay stable. And that is not the case in ULTA stock. We look at their past performance of revenue, and we see that this stock does not deserve a neutral outlook. They've had quarterly increases every single quarter except for 2020. I shouldn't say every quarter, but they've had consistent quarterly increases, as well as net income. Come on. Quarterly net income increases, and you can see that here. They've had very, very impressive growth. So this is definitely not justified by the stock if we just look at earnings. This number should be much higher. In other words, people should be paying a higher price tag on this stock. That is also going to be supported by further analysis into their quarterly statement. So we looked at their earnings. Now let's check out their return on invested capital. That's a number I love to use because it shows the earned percentage on the capital that they use for normal business operations. The way you calculate that is you add receivables, so 201 in millions, plus merchandise inventories at 1998 in millions, and then skip prepaid expenses and other current assets because those are negligible values. And then we're going to include these 4 rows for their operating assets. So property equipment is going to be plus 1226 in millions, then plus 1600, and then finally 11. And then 357, but that is a very small number. I would not include that. So we have a total of 5036 for now. And now the final way to find invested capital is to subtract the non-interest bearing current liabilities. So that's accounts payable, because they don't pay interest on accounts payable. Accrued liabilities, because they don't do that. Deferred revenue, they don't pay interest on that. Like I said, this is going to be a very rough estimate. And current operating lease liabilities, they do pay interest on that, hence the name lease. That will tell you if they pay interest. So we have a total invested capital of 3726 in millions, and we already calculated their earnings for 2025, which is 1291. We get this divided by this, and return on invested capital of 35%. Fantastic news. That is very impressive. Just as a perspective, the last video I made on Dollar General had a return on invested capital of about 5.6%. So this means with every dollar that the company invests into the business or operations, with every dollar they make 35 cents of earnings. And that is quite impressive. I can see why Berkshire Hathaway now holds millions of dollars in this stock. And just to go a little bit further, if we scroll down, I'm going to take a look at their repurchase program. Are they keeping up with returning value to the shareholder? And the answer is drum roll, please. There we go. Shares repurchased from last year was 1135. This year actually increased small amount, 1138 shares repurchased. That's in thousands. So 1.1 million shares were purchased, and the total cost was 500 million. And just as a sort of perspective, if you take 500 million and you see how much that relates to the market cap, so it's going to be 0.5 over 16.8 in billions. They repurchased 2.9% of their, about 3% of their market cap. You could say that's equivalent to paying a 3% dividend. This company doesn't pay a dividend, so that is definitely substantial. And now that you can see that this stock is definitely worth a 13.7 PE ratio, now that I see that, and I'm very happy to note its return on invested capital, its share repurchase plan, I would most likely continue to hold this stock. And in fact, I would look for points where I can buy it at a discount. When you're a value investor, when a stock goes down and its business and intrinsic value has not changed and even gone up, you buy more. This today, I'll give an example of a decrease of 4.3% is good news for me, because now I can buy more shares on sale. Because the intrinsic value is here, and now the price just went a little bit farther down. So I have all this space, all this margin of safety to make money, to have appreciation in my position. And I'll wrap it up with that. I think, for your investments, I think keeping up with them is very, very important. I will do a little bit more information on how exactly you do that, down in the details, with all of the principles that have been taught by the authors of security analysis and so forth. And so I'll make a video on that, on detailing the process, and really educating and showing how that gets done. Just as a final note, let's just make sure their operating margin has not gone down to zero, and it's actually remained around the same, 14.5%. And this company has basically gone down because people are afraid of macroeconomic events. It misses Wall Street expectations. You don't need to pay attention to Wall Street, but the macroeconomic events are not things that are existential threats to a business. When you're looking at a business, you see the business in a self-contained fashion. If you start thinking about interest rates and inflation and wars and epidemics, you could literally make an infinitely long list of reasons that you would never buy any stock. But the problem is that is unreasonable, because first, you never know what's going to happen. No one really knew that the COVID pandemic was going to happen, years in advance, or no one truly knows where inflation or interest rates are going to go, or employment. And so you deal with what you can know. You deal with your circle of competence, as Warren Buffett puts it. And within that circle of competence is our financials, our qualitative aspects of the company, and those are the things you pay attention to when you are evaluating a stock. And it's actually a little bit more calming, because you don't have to constantly be on your toes about where the economy is going, and trying to consider all the thousands of variables that go into the fluctuations of an economy like our own. So I hope you enjoyed that video. I'm going to definitely hold Ulta Beauty stock and wait patiently for an opportunity to buy even more shares. I may buy more at 320. That looks like a good starting point. So we'll see. I'll keep you guys updated. Peace.